chess was a sport that was losing popularity. Then computers basically solved it. And for a human to beat AlphaGo was impossible. And then it became more popular. Why would it become more popular when computers are so much better and so dominant over humans? Humans have no chance whatsoever. Why would it become more popular? And it turns out that what's happening is that chess is now, the computers are teaching the humans. So the humans are becoming better than they've ever been. And so there's a lot of excitement about the fact that the humans are getting better. And so there's
more progress in the game.
Exactly. And so there's more progress in the game. And so it's never been more popular. Chess is the most popular it's ever been in the history of humanity. Partly because there's more people. Partly because YouTube and the internet allow you to massify it. But partly because humans got a lot better. And now humans are much better than they ever were.
I've heard that about Go. Apparently, until we built AI that started being better than humans at Go,
until AlphaGo,
certain types of moves simply did not exist. And when AI played the move,
like,
humans the master just kind of went, whoa, okay. And when it transpired what it was about, there was a mind-blowing moment because, all of a sudden you just have shit that was not discovered before.
It's the rosiest, best path forward, or kind of like view of the world, maybe a little bit idyllic, is they're like, we're actually going to go forward and we're going to have a world in which the outcome of AI is that humans become much better humans. And so we just have these, I'm not going to call them personal tutors because that's also going to be a path that we're going to go in, because we're going to have, hopefully for our kids, you have kids, I have kids, personal tutors. It's actually one of the few things that is correlated with success, is like how much one-on-one tutoring you have. The other thing is zip code of birth, which or actually residence, which is obvious because wealth. But for humans, on everything you do, any sport, any game, there will be an AI that will make you better at the thing you want to be better at. That's like the most beautiful outcome that I can think of. There's so many dystopian ones, but it's also worth sometimes to think about the good ones. And this one is actually fantastic.
I'm looking forward to agents because there's just some stuff that should be done without me wasting time on it. Kind of booking meetings, booking travel.
Yeah, those ones are definitely task replacement. But imagine that there's a chess.com. You know the chess.com app? I don't know if you guys use them, but chess.com app is it's really good. It slowly builds you up to playing chess. It has all these exercises and things that get you better, and it plays against you. Imagine chess.com, but for anything that you want to do in life, for any sports, for example, I love roasting coffee. I roast my own coffee. And the way that I evolve in roasting coffee is experimentation and things like that. And then I read, and I try to read books, and I try to go to forums, and I try to see how to change processes. But I have no tutor. I'm not going to go and find some roaster I'm not going to be an apprentice.
YouTube doesn't help?
It helps, but there's not that many. It's directed. It's not, what could you be doing better? It's about look at this thing that is cool that you can do. And those are very different things.
So they're not looking at you and correcting you.
Exactly. And you learn from your mistakes. The tutoring, the reason why it works so well is because you're doing something, and the thing that you're doing may be done better. And so they tell you in the moment that you're doing something better. And now imagine that I have a tutor for coffee roasting, or you have a tutor for painting, or you have a tutor for movie production, or you have a tutor for whatever it is, interviewing skills. How about you actually talking to an AI and make me a better interviewer? And there's okay, think about this context, think about the background of the person. This is how you craft questions. Are they open-ended, closed-ended? How cool is that? You can actually be better at any one specific thing that you want to be with a personal tutor. That's kind of a cool view. Anyway.
Until it gets bored.
Then you move to the next thing that you want to be an expert. Or the AI
gets bored. and kind of looks at it why the fuck am I wasting time on these Muppets? Mm-hmm. I do it better. And Terminator. Welcome to Meeting of the Minds, number 2. We started this because Web3 is an extremely fast-paced environment. Things are changing extremely quickly. Narratives, successes, projects, live and die, all within a quarter. And unless we stay on top of it and talk to people who are probably best informed, then we'll be missing a beat, and we're probably not going to be moving as fast as we want to. And we're building on Near, and because of that, after the first session, which was with Ilya, we looked up and we discussed between ourselves who could be the next best person to invite. And I've spoken to Ilya, and he also said that Diogo, you'd be the best person. So, let me introduce Diogo Monica. Pleasure to have you here. And if you can, please introduce yourself and give us a little bit of your history, which is incredibly fascinating.
Of course, I'll go and try to do is a long story medium instead of long story short, because I don't think I can do this in short. But at a high level, look, I'm an interesting combination of things. So I was born in the US, but I came to Portugal, where we're recording this, when I was 3 years old.
Which is why we're wearing shorts.
That's right, we're wearing shorts.
It's absolutely crazy hot day, so apologies.
Yes, not as hot as New York though. But,
really? It's hotter today in New York?
It's way hotter in New York.
Ooh, okay.
But I did get, I was lucky enough to have the passport, but grow up in the product of European education, specifically Portuguese education. So I ended up doing bachelor's, master's, and a PhD in something that was useless 20 years ago, which was distributed systems and computer security. So that was my PhD here at Technical University of Lisbon. And then in 2011, there was a company that called Square that flew me out of Lisbon. So if you know Square, it's a big fintech. I was employee 40. I ended up leading the security team at Square for 4 years. Series A company, 40 people, to 1,300 company, $100 billion market cap. So it was a fantastic success. A lot of the good things that I've learned about being an entrepreneur, I've learned them from Jack Dorsey, and I've learned them from the early team at Square. Then after that, I went to a company called Docker that obviously runs on every single server on the internet at this point. Yeah. So I led the security team there and built a lot of the container and orchestration security features. And then that brings me to about 7.5 years ago, when there was a crypto fund that had lost the passphrase to a $1.5 million Bitcoin wallet and offered me 20% if I could break into it.
Okay.
And so that was my introduction to very sophisticated investors, not so sophisticated.
Hacker, okay.
Yeah, well, more like how is it possible that somebody is so sophisticated about finding a field where they're investing and making so much money, but they're not sophisticated at all about operational security and how to do these things right? Yeah. So I started doing consulting until I realized I didn't have enough time in my day. And so I ended up, I was lucky enough to, 15 years ago, join the same week at Square as my now co-founder, Nathan McCauley. So we've been working together for 15 years.
Wow. Okay.
So we joined Square the same week. We go to Docker together, and then we were obviously the right team to start Anchorage. So when the market kind of like showed itself.
For those who don't know, Anchorage is a custody provider.
Yeah, I can describe it a little bit. So Anchorage right now is the first and still only federally chartered bank in the United States that does custody, trading, staking, settlements, governance for all of these crypto protocols. We support hundreds of assets. Last valuation was just over $3 billion. Series D company. We have crossed $60 billion on assets on the platform. The company has just under 400 people, and it's a Series D company with investors like Visa, Andreessen Horowitz, Goldman Sachs, KKR, Apollo.
Electric Capital?
Yes, Electric Capital. Yeah. And we also have some of the PayPals and lots of great companies and great people. It's been a fantastic journey. It's 7 years in, and then just more recently, I promoted myself to executive chairman of the board. So yet another title for you.
You need to correct your website. It says president.
It still does. So I co-founded the company and I was president for the past 7 years. But now I'm taking more of a board role, strategic role, and I joined my longtime friend, Katie Hahn, at Hahn Ventures. So I'm now a general partner at Hahn Ventures. And most importantly for this conversation, I also was lucky enough to be invited as chairman of the Near Foundation. And so I've been working with Ilya for the past almost a year and know the space and been ramping up on the team and on the Near ecosystem itself. So those are my 3 titles and the 3 things that I do.
Fantastic. As far as your skills, history, and different angles that you can potentially provide, this is actually quite rare, because in the space you very frequently have builders or capital allocators. And it's very infrequent that builders become capital allocators.
In fact, I would say that right now I'm probably the only crypto founder that is a venture investor. There's nobody else.
Yeah. It's very rare, and it's very, very encouraging. Hopefully there will be more, because to be honest, I think that, kind of understanding how it is to build a company and understanding tech is incredibly valuable. Apparently, a lot of capital allocators are saying it can be detrimental because then you look in detail, but that is probably because they are, kind of when they really look deep inside, they realize that imposter syndrome is really, really strong.
And I would also say
give very little advice, hands-on advice.
It depends on how you're looking at this, by the way, because I do think that the jury's still out as returns are concerned, whether operators are better than consummate investors, so people that actually come from an investment background. I would actually say net operators are probably slightly worse investors. So I do think that founders have, they bring to the table a lot of things that end up not being useful in terms of the pure financial returns of the fund. Yeah. However, they're much better at closing, they're much better at having empathy, and those sometimes are actually the things that play against them. But I will say one thing that you mentioned that is important to have somebody that understands the plight of a founder. I think you didn't go as far as you could have, which is in crypto is even harder. In an economy or a type of business where every 3 years, 80% of your revenue disappears, but the same employees stay. And so your burn just multiplied by 5, and you're burning cash because your revenue goes away. In a space where, in many cases, narrative matters more than substance. In a case where you said exactly right, which is things live and die in quarters, in terms of like potentially whole industry, whole narratives.
Absolutely.
It just becomes extremely hard to actually be a successful entrepreneur that wants to build something real. And so, kudos to you because it's a very hard space to build in. And it's very easy for you to do sort of flash in the pan, do something that's not real, market it and let it die, but to build something enduring, like you guys have done, it's very special.
That's very true. But I also feel that we potentially overestimate how complex Web3 is because we're realizing this. But if we were to talk to early founders in the internet, I'm an old fart actually, and I remember some of those conversations and some of those investments and theses that I've heard and metrics that people were chasing. I think that one of the major factors why we are where we are in Web3 and why it's so hard is because it's a startup industry, which means there are no playbooks. There is very little that you can go and copy from somebody because, kind of success stories are actually far between because we define success right now very frequently just by pump of a token. But if you look at long-term trajectories, long-term survivability, there are very, very few projects. So there are very few success stories. There are very few playbooks, and we're building them right now. It is easy in Web 2 because you know what metrics that you need to focus on. At the pre-seed, it's all about founder and about the vision. At seed, it is about product market fit. Then you are proving that you can scale. Then you're proving that you need to generate revenue. Then you prove that you got unit economics. Everything is very, very clear, and these gates are known to everybody. In Web3,
that's not the case.
I remember our conversation because we actually had a conversation probably about 2 years ago about metrics, and they were just saying that, look, it's insane that we're continuing to focus on TVL. And I remember your answer was like, no, TVL is absolutely right. And I'm like, active users, TVL leads us into all of these places. And as a result of that conversation, I actually changed my thesis fundamentally that it's not that TVL is the wrong metric, but very much like in Web 2, we figured out what gates you go through and what metric you chase at each of the stages. Same thing applies for industries. That's right. TVL was a fantastic metric to start with, right? Because, it's clear and it was all about financial assets. But now, if you're focusing on TVL, and I'll share a story that I've heard, firsthand from founders, somebody comes with a business plan and they're building, mass market focused product. And they're saying that, we're going to drive adoption. We're going to bring next billion people, but our success metric is TVL. What happens is, as you build a product, you realize that you can hit your TVL goals by making 5 phone calls and attracting 5 whales. That's right. And then you end up throwing the product that you had in mind away because the product that you need is for 5 people. And therefore, you replicate what they're using right now, maybe with a few bells and whistles, but fundamentally, you are stuck in a rut of what's already there because you're shuffling capital around as opposed to reinventing the wheel. And as the end result, they build product that has an appeal to maybe a few thousand people, because next billion people would never be able to figure out what it is, kind of how to use it or even what these terms mean. So I feel that we are in that moment where TVL matters. I mean, for Anchorage Digital, that's the metric, right? I mean, you're a bank. Banks, how much capital you have under management matters. But in our case, for example, that we're building B2C business that is making the world more physically active and hopefully wealthier. If I were to focus right now on TVL, then I would go squarely for whales or people who've been in crypto for a long while. And then I would probably build Stepan.
Yeah, totally.
And would it actually have longevity? Would it have the same growth trajectory?
What you're bringing up is pretty interesting, which is this thing of the reality that tokens have a superpower and a super weakness.
Yeah.
Just at a base, not just looking at the metrics, but the superpower of tokens is that you can overcome cold start problems. You want to create a network effect. It's extremely hard to start. You have these things called tokens. We align the incentives of the users and we bootstrap this problem. There's irrational behavior we can cause that gives us a chance of overcoming the cold start problem and thus bootstrapping a strong network effect. Now, the problem in the super weakness is that it hides away all the product market fit numbers that you should be looking at. Because even if you are looking at the right metrics, they're all hidden amongst the noise that you've created in your attempt to overcome the cold start problem. So it's even harder when you're saying, because yes, you're absolutely right. It's not just about one metric. It's not just about one metric in one specific,
even stage of development.
It's actually that in all stages of development, once there's a token dynamic, you might be confusing all the metrics that you're looking at because of the super weakness of tokens in order to take advantage of the superpower, which is the cold start problem.
Yeah. No, in Web2, there is one of the kind of most well-known mistakes is to raise too much too early. And, if seed round was tens of millions, I've seen boo.com, you probably remember, and it's very, very frequently when you raise a lot more, then you solve every problem by throwing money at it, and it masks your, product market fit, because you can buy traffic, you can buy loyalty, you can buy retention, you can do all of these things, but actually, do you have product market fit? Can this thing stand on its own without constant injection of capital? Is a big question. And in Web3, 2 days ago, there was a project that raised 18 million in like 20 seconds. And for the last 72 hours, there was not a single people's quake from the team when token holders started to ask questions. What's going on? How is that freaking possible? We are very, very early. And, I agree with you that we need to start thinking in kind of stages and what next stage is. And this is kind of thesis that we've been discussing here. I see more than 1,000 chains in existence right now. There is no week that passes that I would have multiple conversations, either with our investors asking us, why don't you build your own chain? Look, you have 3 million active users. You'd be one of the top chains in terms of, activity. Don't you think that this is really, really valuable? Okay, the world needs another chain. Or I would get approached by a team that would go like, you know what, everyone's building their own chain. We can build a chain for you in a month. Don't you want to do that? And it's going to be really, really cheap. And all of this right now is making me feel really uneasy, because if there is more than 1,000 chains already out and there are more being built, and if I look into DApp radar, and I look at all dApps in the world, and I cut off at the number of 1,000, so 1,000 active users per month, which is not a lot. I mean, frankly, if product has 1,000 users, are they at scale? Hell no. Yeah. But if you cut it at 1,000, then you end up having about 550 projects. Now, if we use old, analogies that blockchains or chains are rails, then dApps would be carriages that run on them. Now, if you have 1,000 railway companies and only 500 carriages running on them, then it feels like, we're either really, really underinvesting and under-innovating in dApps, actual consumer products, or we have certainly overinvested in the infrastructure. And I believe that what we're going to see within, probably, and you suggested this timeline, but within next 12 months, we're probably going to see a massive infrastructure bubble bursting. And a lot of the infrastructure projects failing to give any meaningful return. And I expect that in this shift, there is only one answer that we can also pick up from internet, from television, radio, and even from the Industrial Revolution, that the money and capital allocation is going to shift from building infrastructure to building consumer applications that are using this infrastructure.
I think that would be a great outcome, and I really hope that we do see that. And by the way, I think we're in a very different space and spot than we were 7 years ago. Yeah. 7 years ago, you couldn't credibly say you had the ability of moving dollars sub 1 cent in a way whose confirmation was like in a few seconds in hundreds of thousands of those transactions, that you can support a Visa-like use case. Now you can. So we've solved a lot of these issues, but we've solved them, like practically speaking, within the past 12 months, 9 months, if you want to look at it that way. So we didn't really have it before. So now we're at a point where it feels like we have no more excuses on that side. Yeah. To a certain extent, I can position it that way, or just we've built all the building blocks. And so absolutely a lot of the focus, I hope, and a lot of the successes should be with the consumer applications and apps that actually build on top. But I think the things that you mentioned are pretty interesting. I will point out a couple of things, which is in our space, you've been doing the comparison between traditional companies and traditional markets and crypto companies. I do think traditional companies have one big advantage, of course, not one, many, but one of the advantages is you have this thing called a public market. Yeah. Public market is a very narrowing of the funnel for which there's a lot of scrutiny, hundreds of years of history, where the metrics are known and where there's a real time with high amounts of liquidity, voting and weighing on like what these companies are worth based on these business models that they have. And so to a certain extent, when you're a private investor, you're kind of like backtracking from that. You know what the comparable is on the public company, so you know sort of what it looks like. Yeah. And that's amazing because you can sort of judge things and give companies at the right stages of risk, the right amount of money for them to unlock the next step. Yeah. But it has another big advantage, which is there's no such thing really. Well, there is, but not really like we have it in crypto, like zombie companies. Yeah. Because companies sort of run out of money. But no crypto company runs out of being listed in token valuation. Yeah. And so the reality is that when you list tokens, you are getting a very highly inflated view of the market, because the reality is that many of them are dead. They're just like, they're zombie companies that never get taken away from the exchange because the exchange have no incentive for actually taking away.
As long as there is some trading going on, they make fees. Right.
But that would be not the same thing. So I think to a certain extent, maybe what we need is the OTC pink slips type situation where you have the exchange that has the big ones and the companies that have made it that have IPO'd, and then you have like everybody else. And once you become a sub-cent or a sub-dollar type of stock, you kind of like go to another stock exchange that is like more Maybe that's the concept that we sort of need.
Penny stocks.
Penny stocks. Yeah. I think that might be actually the equivalent here that we just simply don't have. And then you're absolutely right, because things get liquidity so early, but there's very little float, and there's these like vesting schedules. It also confuses the signals of the market. And so you think that you're raising a company that it's very common. I see a pitch and they compare themselves with a company that has like 1%, 2% float. And it's just like, see, I'm worth $10 billion, or I could capture $10 billion. I'm like, no. There's an illiquidity premium here for the investment. There's like, this is not apples to apples. And so it's not $1 billion. The reality is like, your opportunity is not, or your comparables, comparables should not be those. So that does confuse a lot of the investment conversation, and in particular about infrastructure. That's why you have the layer one, because all of them are valued something. None of them ever die. You have those comparables, and if you're looking at them as if they're public markets, then it does make sense for you to look at your peer set and then say, oh, I can create something that is better, that is also around the same amount of value. But I think the most interesting thing is, I don't know if I buy into the rails and carriages analogy. I think the best analogy, I think it's a good one, and it drives the point home that you're trying to drive, which I agree with, which is we need less infrastructure right now and more use cases on top of the infrastructure. But the way that I intrinsically think about layer ones is that it's somewhere between programming languages and operating systems. And I think we've talked about this in the past, but I think that's where we're going to end up. I think we have very few operating systems. We have Linux, we have iOS, we have iPadOS, we have macOS, we have Windows, and then we have Android, and then, there's not much else. There's like these real-time operating systems, these little things. But there's, let's say, 10 of them.
Same thing with languages, actually. If you look at languages that are broadly used, you're probably talking about 10.
But actually, in the language, there's a lot more. So the reason why I love languages is because you have quite a few operating systems that are really tiny, but you have tens of thousands of programming languages, actually, because anyone can create one.
Yeah.
So layer ones are like programming languages, but they're listed on like a public exchange. But the reality is that if they behave the same thing, what ends up happening is like, look, at some point, all layer ones sort of do the same. And all programming languages actually do the same. They're all Turing complete. You can actually build the same program, exactly the same program with the exact same outcome, provably through Turing completeness on Python as you can on C, that you can on Rust, that you can on all these things. However, they have different characteristics. One is memory safe. The other one is like
it's about speed.
It's speed. The other one is like nicer because they look sort of like English. But the reality is the reason why you have different programming languages that are popular, even though all of them do the same, you can try to bring the analogy of all layer ones do the same. Not quite true yet, but imagine that all of them do the same. Why would there be more than one? And the answer is why there's one more programming language. And I think the reality of what's happening is like, why does Ruby exist? Really, as a programming language, why is it popular? Well, because Ruby on Rails, right? There's this one framework that made the language. There's this one developer use case. The same way that Python is very popular because of all the math, Pi, and the things that were built on that, on the AI use. The same way that Rust is popular under one subsect of people. The same way that C is popular because when it came in. And so I do think that that's like, my mental model is we will have sort of roughly the same number of layer ones as we'll have programming languages that are popular.
No, I like your analogy, and I think it's actually fairer because it's also closer to technology. However, I would argue that the point still stands. So you're not going to have a very, very long tail of railways, but you have an incredibly long tail of languages. And I agree with you that, we, even in our history, we had to write a certain piece of code in Go because we had such high loading, and Ruby on Rails just wasn't producing throughput that was required. Go could deliver the same result, but because of efficiency, I don't necessarily understand all the nuances, but we had to pick it up in order to get the pipe smoother and the velocity increased. So there is a role for niche languages, but we're not talking about that. We're talking about winners, right? So we're talking about big stuff.
Yeah, and so by the way, I think I'm fully square on like, we need more dApps, we need more shots on target there. I would hope for venture funding teams and companies to really fund like consumer use cases are really interesting.
Yeah.
But let me try to like make you an argument. I think the best argument for all of these things in that tokens help on is people talk about speculation in crypto, and usually they use it as a dirty word. I really don't believe it's a dirty word. And so I think there's something really interesting happening right now, which has never happened before, which is by putting tokens on these infrastructure stacks, on these layer ones, on these layer twos, on these vertical integrations, on these DAs, on these combinations of things, we're actually creating a market-based voting machine on which stack is going to win. And that's kind of fascinating because the hypothesis is that we want 1,000 flowers to bloom, and then we want to cull them as fast as humanly possible because we want to accelerate Web3 technology as fast as humanly possible. And the way to do it is to create market incentives for people to make money on the winning technology, and then shoot as many, like shotgun approach, as many corners of distributed systems as you can, and then vote on them on a market-based way, which is tokens, and then see what comes up. And so in that sense, it's kind of like it's incredibly healthy what's happening, just because we have incredibly smart founders building super cool types of things, because we're really trying it out. If you think about it, it's kind of hard to believe that we're going to have some kind of permanent basis of layer one blockchains in which there's absolutely zero anonymity. And there's pseudonymity, but there's no anonymity. Even like controlled anonymity, even like compliant anonymity, which is perfectly possible. That seems like a weird place to end up. And so clearly there's more steps that we have to make and more voting than we've seen that. So in that sense, it might be, consider this, there might be a world where this continues exactly unfeathered. You will continue getting as many pitches of layer ones as you see. You continue getting as many people trying to try the same layer one because people want to vote on the sweat layer one being the winner. And you might believe that actually no, the sweat economy works better on a layer one that also already has these characteristics. Yeah. But the market is voting on it by buying NIA or voting on it by buying Sweatcoin, right?
But I'll actually bet with you that the shift is going to come. and it is going to be away from layer ones. And thesis is actually, my thesis is very simple because it now became blindingly obvious why would token that is a gas token on a chain would have value, right?
That's right?
And the basic thesis is if we build an ecosystem and builders are coming, in order to build, they will need to have our token, therefore there is utility, therefore there will be price. We don't know what it will be, but that is a very, very easy concept to understand. When Vitalik was talking about it in 2015, everyone was just going to go, what? How? What? So that wasn't a universal truth. Right now it is universal truth. And therefore, to come with a pitch and use exactly the same metaphor and then hopefully have a differentiation and the reason and purpose, like the latest one I've seen was, let's use something photomorphic encryption.
Fully homomorphic encryption. That's right.
On the fly. 3 transactions per second maximum. But it is completely secure. Nothing, nothing can be seen. Nobody can understand it. And I'm like, but it's 3 transactions per second, right? So, people are continuing because it's an easy pitch. It's easy to understand. And then you're looking for differentiation. But coming back to your point is the whole history of, humanity is filled with bubbles and bursts. And the reason for it is it's like Cambrian explosion. We still don't know why Cambrian explosion happened, but there was a proliferation of types of animals, and right now they're dying off. That's the same thing that can happen in blockchain world. Now we have 1,000 chains. The only path is actually down and reducing it because you need survival of the fittest. So that actually prove their mantle and their worth and their differentiation, and if there is a market to build on them. So the number of chains is going to shrink. It will never be one. I don't believe, I totally agree with you that, there will be completely different use cases, but it is not going to be 1,000, especially given the fact that there are only 500 applications that exist. Because in order for chain to have a purpose in life, it needs to have somebody building on it. But if nobody's building on it, then what the hell is this chain? I lived in the UK. The history of UK and history of railways is fascinating. Before 20th century, there were more than 200 railway companies. Then they collapsed into 7. Then they all get nationalized. And then they had to assign humongous commission that resulted in wiping 60% of all rails because there was no traffic on them. They were just sitting there rusting, right? That reckoning is definitely coming. And I'm actually excited about it because I see, as I mentioned to you in our kind of private conversation before, I see exactly the same picture happen in internet. All the money before year 2000 was going to infrastructure, Sun Microsystems, Silicon Graphics, data centers, pipes, kind of building cables across continents. All the money were going there. And then something happened around year 2000 where the returns and the excitement of building more infrastructure kind of waned, and Google was born in 2003. Facebook was born in 2007. And guess what? They were not using, ultimately, the infrastructure that was built. They actually bought a lot of the infrastructure that was paid for 20 cents on the dollar because a lot of those data centers, they were not built to deal with Facebook's use case. The concurrency, the load, the architecture just wasn't there. They had to build all of these tools that everyone is using right now because they're out, kind of open source them. But every industry always overinvests in the infrastructure, and then there is a survival of the fittest, and infrastructure forms a layer, and there are players that live really, really comfortably. But big tech and the biggest returns in the internet were not made in the infrastructure. 100%. They were made by Google, by Facebook, by building those businesses that scale to humongous size.
But I wonder what the
and they were building
because we have such open source infrastructure right now that's kind of interesting, right? There's no capex, there's no things on there's no fiber optics on the ground, there's no hardware. It's kind of interesting because tomorrow you could actually just launch your own chain, fork a chain, and can really use the winner, use whatever winner. So it really has to be about
we could build a sweat chain, kind of.
That's right. They've been selling it to you.
If I answer to some of those people in Telegram, then we'd launch sweat chain in a month. And some investors say, you'll be able to raise tens of millions. You know,
I think you're absolutely right. I think you're absolutely right. The orthogonal thing that I always think about it is, by the way, as a capital allocator, is we're bearing billions of dollars into this tech, but it's kind of cool to think through that a lot of the money that's being spent is actually going to have a lot of positive externalities. And what I mean by that is we are spending billions of dollars in core cryptographic research and zero knowledge proofs and fully homomorphic encryption and all of these other aspects of distributed systems. But the reality is that, you know who's going to use fully homomorphic encryption? Databases. Not blockchains, maybe blockchains too, but databases. It will be JP Morgan Chase, it will be the banks, it will be the corporates that will win the most, that will have the most value because of fully homomorphic encryption. Zero knowledge proofs has so many applications outside of crypto. We're always looking for crypto applications, and they're the obvious ones because of layer 2s and because of size constraints and because of proving that things are correct in a decentralized world is actually one of the ways that we actually create distributed systems. But the positive externalities, like the things that it will solve the fact that AI generates all this amounts of data, right? AI generates digital abundance. In crypto, enforces digital scarcity. They're perfect for one another. There's nothing working on right now, but there's positive externalities in crypto that can help us with that. They can help us with misinformation, can help us with data origination, can help us with all these other tools, can help us just with databases, safer databases. Imagine that all of your data is always in a database that the owner of the database can actually operate on, do queries on, but can actually read the data. And so hackers can't really steal plain text dumps like they've just done with some American banking as a service providers. So I do think that the positive externalities of crypto are something that I always think about. Orthogonal to our conversation, it's kind of cool because all that money is going to be put to good use by either crypto or somebody else.
True, some of it, because the kind of incredible amount of it is actually in duplication. I mean, how many EVM chains do we have right now? Right. What unique characteristics do they have? How much of a true innovation have they brought? The jury is out there.
But you'd hope that those wouldn't raise much capital.
Well,
that allocators would be efficient at saying, no, you have nothing new.
They used to. They used to. Right now it's very, very difficult, but they used to. But right now it's, full homomorphic, encryption that is, kind of allowing you to get a check.
Oh, but there's also post-quantum.
Ooh, yeah. Let's not go there because that raises questions about the value of Bitcoin because actually with those things, private keys, not going to be terribly secure.
Yeah.
So, a lot of people
hits encryption. It hits encryption way worse than it hits signing. And by the way, we can always simultaneously add new signatures. So imagine that we just have to patch Bitcoin to have a quantum safe signing algorithm side by side. And yes, Satoshi's keys might be screwed because if Satoshi doesn't have access to them, they won't be able to ever update them. And so they'll be hacked. But at some point we can say, no, from now on, we always sign both. And then we can have ECDSA live alongside some post-quantum safe signature algorithm. So we can actually update the blockchain pretty easily. So I'm really not concerned about for our field. We will have ways of going back. We'll have the ability to actually mark on the ground, hey, this is the pre-quantum safe algorithm. This is the post-quantum safe algorithm. So I'm not super concerned. I feel like that's all fear, uncertainty, and doubt, mostly more than anything else. But encryption is absolutely right. If you have an encrypted payload and you have the payload there and what you're trying to protect is some private information, and if in 20 years a computer is going to be able to break into it, then you're kind of screwed because the information is coming out, whether you like it or not. But for signing is different. Yes, prior signatures will be unsafe. You won't be able to trust the key that was generated in prior algorithm. But also cryptographic algorithms that are signing algorithms are in general less vulnerable to quantum. So.
The thing, I'm not a builder. Well, I was supposed to be a builder, but I just didn't make. Well, I made right choices at the right time, right? So most of my school friends are either engineers or quants and banks or physicists and mathematicians. I grew up in that environment, and that was very, very natural to go for it. But it was end of Soviet Union, and I really wanted to see the world, and that definitely wasn't the path to take if I want to see the world. So I went into languages, international, blah, blah, blah. But my brain does work very much like a builder. And that means that I'm compensating by thinking about the user. And there are very, very two interesting things that I see. One is it's blindingly obvious to me that Web3, if we think it is going to be a humongous, big mainstream industry, will grow by adding billions more people, right? It would be very, very difficult for it to continue gain momentum and really kind of follow the trajectory of the internet if we are stuck at this 300, 400 million people that are in it. So we need to go broader. And, I'll talk about this audience and kind of what they want and what they need and how they perceive Web3. And then there is another trend, which I see, which is crypto native. So people who've been in the space for a very, very long time. And if we're talking about next billion people, and we've done a lot of research when we were preparing our launch in 21, 22, because of course we launched in 2014. By then we had 120 million users. We had a whole segment that was mums approaching the empty nester stage. Now, like 50, 55, with teenagers, because it's, kind of Sweatcoin, the original Web2 product, is fantastic for the interaction where a teenager shows up from school, goes, "Mom, you're fat. You always wanted to be more physically active. Here is an app for you. Install it, walk as much as possible. Don't worry about Sweatcoins. Send them to me. I'll figure out how to spend them."
If my teenager came home and told me that, I would be extremely upset. Jesus Christ. But I believe it.
But
As a teenager, it's true.
In the US, that's exactly
Teenagers
what was going on. I interviewed these moms. And they are excited because all of a sudden at breakfast, next day, there is a conversation about how many Sweatcoins she generated. And she's having a chat and he's giving her grief. That's not a lot. You walk like 3,000 or 4,000 steps. So there is a banter and there is a chat, right? So we had huge group moms and we were concerned, look, if we're going to crypto, maybe they still think that it is what was the name of that drug marketplace? Silk Road, drugs, illegal stuff. And we've done a lot of research, and you know what we realized? There was not a single person that wasn't interested in going into Web3. There were 3 big problems. One is most products that were marketed or mentioned are not necessarily the products that they even use in their day-to-day life. Just having cash, but why would I have it in crypto? And then there was trading and swapping. Very few people use Forex and, kind of need to swap between currencies. So propositions were not necessarily extremely attractive. Getting rich quick is fantastic, but then next one kicks in, which is really horrible onboarding experience. I interviewed a guy who said, I did manage to install a wallet, and they showed me 24 words, and there was a text saying that don't screenshot it, don't copy it, scribble it on the metal plate, split it into 2 halves, and keep them in safes in 2 different locations. He's like, what on earth is this about? And then there is a third step, which is especially for women in our research was just insurmountable. Even if you manage to do that 24 words, piece of metal, different safes, then the first step is you have to pull out your credit card and buy a lot of ETH, because unless you're buying like $500, you probably wouldn't be able to even pay kind of few transaction fees, right? And they are afraid because basically they're going in, they want to learn, they want to understand, and it costs $500. And all they hear from mass media is 600 million drained from Ronin Bridge, 300 million drained from this bridge. They think it's going to be them. And lack of propositions, really horrible onboarding experience, and pay up front before you can get anything done or even understand how it works was the third one. And that's when we realized that, actually, the next billion people, we know how to get them, because you know what? Our proposition is you walk, you put one foot in front of another, we pay you. A lot of people have a question mark. Why is movement valuable? But you know what? There are a lot of reasons for that, but we'll probably touch on them a little bit later. Then we know how to build an onboarding experience that does not put you through that hell.
It's pretty slick.
And the third is, you put one foot in front of another, you earn your cents and then your dollars, and then you send, receive, stake, win rewards. And all of a sudden I'm kind of going, I'm getting hang of it. And then I'm pulling the card out, and then I'm starting to play in Web3. And basically what I'm saying is that the need of this next billion people is great propositions, extremely simple, and don't ask money, as the first step. In crypto natives, the theme that I'm picking up right now, and if you go on Twitter, I'm sure that you can find, even in, people you follow, it's like, I've got 15 wallets. I know that I had this 10 grand USDT somewhere. I just can't figure out what chain, what key, what address. People have an absolute mess of their assets.
Right.
And they're asking, is there a wallet? Is there a unified experience that can give me view of all of my assets? And if you bring these two things together, from both sides, the signal is we have created too much complexity. It needs to be simplified, and a lot of stuff needs to go into technology layer and is done without asking users questions. Our swap feature does not have slippage, because we realized that if we put slippage in there, that was a showstopper for people. What is slippage? And then you need to have an education session on slippage. And then they're trying to figure out, is 2% okay, 1% okay, or you just hide it. And then there's no problem. They just go through and they, and they trade. But for crypto natives, that interface, I can't use this without slippage. That's back to our conversation about, if you target TVL, then you're going to have slippage. If you target next billion people and active users, then you remove slippage, and this is something that you hide under the under the hood. And that tells me that several things are happening. One is people are focusing more on assets as opposed to chains. This tribalism of, I'm Solana, I'm Ethereum, I'm Polygon, I'm BNB, I'm Avalanche, I'm Near, is going to go away, because you know what? When you use an app right now, you don't care if it's built on AWS or GCP or Azure. You just want it to work. And would you care if your Bitcoin that you own sits on Bitcoin chain, or that Bitcoin sits on Near chain, or it sits on Solana chain, or on BNB? As long as it's secure and you know that somebody can't take it away from you, why would you care? In the future, you won't. And this is actually why I am excited about meme coins, because rather than focusing on ecosystem and having excitement around the chain, we have started creating excitement around assets.
Right.
And I believe that this is the future for both next billion people and for crypto natives. And that's why I believe that consumer crypto is the future, because next sort of benefit that we're going to have, or the next big wave that we're going to have, are the consumer crypto applications that giving you full visibility of your assets, ability to control them on whatever chain they're on without even caring. I mean, to be fair, if I transfer something, from one bank to another, I don't care if it's Swift or if it's in the UK, there is BACS, there is fast transfers. There are so many different payment, methods, but you know what? As long as money gets there, I'm fine. And ideally it's cheap and it's fast. I don't care about the underlying tech. And now, when I talk to capital allocators, they say that, you know what, we are actually shying away from consumer crypto because there is a lot more risk. With layer ones, we understand the pitch, there are comparables, you can see all of this stuff. But with consumer crypto, we don't see a lot of successful stories. And this is why this is going to explode, because you know what? I'm sure that it was the same case in the 90s in the internet, right?
But what do you feel like it's holding back some of these? For example, obviously, like you have Near, fast transactions, great consensus, low latency, high throughput. You can actually build things without layering them and cheap fees. You have already built an awesome app that has like a clear product market fit and use case. You have 3 million actives. Do you feel like is something in crypto like holding you back from like getting to 30 million actives? Is there something that actively hasn't been built? Is it infrastructure? Is it education? What
chain abstraction. Because you know what? Right now, I'm building a near, and we're limited to near. If I can offer our users assets on any chain without them having to create an account, fund an account, breach assets from another chain, which is really, really quite a complicated task. But you know, you live in Europe right now, right? In the US it doesn't exist, but there is an open banking initiative in Europe, right? What was the driver of it? Banks have a relationship with the customer, and they can only show you assets that you hold in that bank.
That's correct.
And regulators, European Commission, started asking, hang on a second, why? Exactly.
Yeah.
But banks managed to do it in a way that you can only see the picture, but you can't manage it. So you can see complete picture, but if you want to touch that money, or you're going to go into your Millennium BCP or into Signum or here in blockchain, that is inherently there by architecture.
That's right.
So if you build full complete picture, you don't see it only, you manage it from that interface.
Yeah, so chain abstraction on EAR is absolutely right, because it abstracts the complexity of owning assets on multiple chains and allows you to basically provide a unified experience across all of these different things. So basically what you're saying though is that there's interest in these users, and part of these users want to come to your ecosystem. But we talked about two different types of users. We talked about crypto natives, which do care about holding different assets, and we talk about non-crypto natives. We talk about the mom, whose teenager comes home and says she's fat.
Yeah.
So do you think for the mom whose teenager comes home, that what is the holdup there? Because it's not ownership of different assets, or is it? Is it that she wants to own Bitcoin, but she wants to own Bitcoin on Sweat, and that's different? It's hard for you.
You know, on our Web2 kind of site, we have 170 million users.
Gotcha.
We know that we can pull them in. You know, there is really no barrier in terms of bringing them in. But do I want to migrate all 170 million users in Web3 right now? And I can tell you that the answer is I'll be quite careful at this moment of time, because, and we've seen it time and time again. We bring in people, we educate them, we make them comfortable. Then they go, ooh, what about Ethereum? What about this? And because we, inside Sweat Wallet, we cannot give them access to those chains and those assets or those dApps, they go and they install MetaMask, or they go and they install Trust Wallet. So we're on-ramping people, we're putting effort into making them comfortable and willing to participate in Web3, but I'm losing them to somebody else. Why? We've brought them in. I would like them not to have to go anywhere, but to be able to stay in this comfortable place that they trust and have access to each of those assets and each of those dApps and each of those products. That is the next best thing that we can build. Basically, if NEAR can abstract other chains and stop being a chain in the mind of people, but it is an enabler of the front-end experience.
Right. Across everything.
Across everything. Because the future, very much like Google and Facebook ended up making all the money in the future are going to be made by interfaces that users trust to keep their key.
Right.
That's going to be the only place where you will be able to levy fees. Because unless there is a human participation, or there is a prior approval to charge certain fees, which is still human participation, the fees are programmatic, which means that the only place where you will be able to actually do something and create profit is going to be there. And these front ends ultimately will be controlling who in the back end, which chain is going to be processing those transactions. Very much like now, if you have an e-com business, you know, if your logistics provider is not delivering your packages, you go to another logistics provider, right? Same thing here. My users want to have fast and cheap management of assets. If this chain is not delivering it, I will be using a different chain. And these front ends, therefore, will be controlling revenues of chains and how much those chains will be making money. And these trust layer, or the human to machine trust layer, where your key is going to reside and where you're ultimately going to be making decision, is going to be where Google's and Facebook's of Web3 are going to be created. And a lot of people are not realizing that because they're building game, for example, right? I mean, game is sort of thing in itself, but the value is actually going to be created. You know, Chris Dixon, you know, read, write, own.
Right.
So Web3 is ultimately about ownership and control of your assets. And unless your vision is not to build something that is going to give incredibly simple,
right,
incredibly useful, ubiquitous across chains, asset ownership and management solution on the mobile.
Yeah.
That's one thing that, you know, kind of, I was talking to Chris Donovan, CEO of Nia today, you know, kind of one of the things that I think very few chains realize as well, that next billion people, they're not going to be on desktops, they're not going to be on laptops. It is all going to be native apps. Because I just traveled last year in Africa, and, you know, Maasai with the herds of cattle, they stand there, they have a spear against a lion and a smartphone. Yeah, all of them, you know, these guys don't have electricity in their villages, but they have their kind of the battery, the solar panel, and the whole village has their smartphones. So it's going to be on the mobile, and it is going to be about managing assets. And I'll go further to say that I believe that crypto front ends will ultimately also win the battle with banks and with traditional finance.
Yeah.
Because inherently, there's going to be open, so you don't have to have a relationship with this chain or that chain, and you're not going to have to use 15 different things. And as banks are starting to lose liquidity, traffic, etc., they will have to start opening, like open banking in Europe. They're going to have to start opening their interfaces to add, you know, their assets, visibility of assets into these front ends that will ultimately become the kind of the center of wealth management for these users.
When you talk to these 100 million users that you have on one side that are not using crypto wallet, what are, I mean, the 3 million users that are on crypto wallet, what are the main incentives that lead them to go into the crypto experience? So let's eliminate, you know, getting access to Bitcoin in the crypto economy, participating on Web3, like on Sweat itself, they can vote, they can participate in governance, they can stake, so they can put sort of like use financial, these sort of financial things, like I earn more if I stick in there. So those things are exclusively part of the wallet experience, the governance, the aspect, they can take the token away, they can do whatever.
Absolutely.
What other things resonate with users? What would basically like make users on their own want to opt into the Web3 experience from your normal traditional Web2 experience?
So look, I mean, one of the reasons why we don't have 100% of users opting in is because when you come into Sweatcoin, it's still health and fitness. It's a pedometer with benefits.
Right.
And crypto for a lot of people is still a thing that is quite interesting and enigmatic, and they go in. And the reason why they go in is because they want to familiarize themselves. So we don't have an awful lot of crypto natives yet, but we will. And right now they're going in, okay, what do I have to lose? I mean, look, it's a smooth experience, none of that, you know, kind of seed phrases complexity. I understand why I would install it because, you know what, these guys pay me in crypto for steps. And third, they don't ask money up front. When they go in, the stuff that they do, you know, it's, you know, basically very, very simple. They all start with sending and receiving. Then they go and they opt into rewards because the way our platform works is that, you know, you can just win things by effectively opting in to participate in the prize draw.
Right.
But it is a tiniest of Sweat transfers because we want to have everything on chain because then it's fully traceable. Right. Then anyone can go in, look at the contract, get the full list and see the winner, right? So that we don't have to sit there and constantly prove that, you know, the systems of selection are robust. It's all public. You know, and we even run these things on YouTube so that people can see in real time how the whole thing works. right? Then they go and they discover grow jars, which is not staking,
really
because when we tested staking,
Nobody.
staking is, I don't know how you kill the vampire, right?
But growth jars are more
But
obvious.
grow jar is, I understand that. So then people, they compare the yield that they get in sweat versus what their bank's paying them. And they're like, wow, I like it. So they put all their earnings into grow jars, and then they go, hey, hang on a second. Actually, the value of the token, and this is really, really fascinating, is the value of my physical activity. Right now, if you convert our token into 10,000 steps, it's 1 cent. Our users kind of go, no, this is not a fair representation of the value that they feel their 10,000 steps are worth.
Right.
What do? They don't sell. They put them in the grow jars because they understand that the value of physical activity is going to go
Increase.
up.
Right.
So this is the reason why we have very, very low sell pressure.
Right.
And most of these people are putting everything in grow jar and even buy sweat to add more.
And once they come into the crypto economy, into the actual crypto side of the app, or the crypto app, better yet, are there other crypto experiences that they can integrate with directly that make
Swapping,
and outside of swapping, participation in other ecosystems, like
every big decision is done by the community. We now have a vote running because we're changing token economics.
Oh, I voted today.
Did you?
I did. I just voted today.
Okay, please don't tell me that you voted for keeping the.
I voted for the recommendation, the new one.
No, that was, and actually, I hope that this is going to end up on our Twitter. You know what? We were launching, and then somebody in the community kind of went, guys, why do you cap at 5,000 steps? Why don't you start at 5,000 steps and, and reward everything? And we just kind of went, why didn't we? And everyone looked at each other like, shit, okay, it's a bit too late. But then this idea started coming back again and again and again, and we want to change it.
Right.
And we now have, 90,000 people already voted.
That's pretty cool.
We're probably going to have 150 to every big decision is done by token holders.
And are there communities that can participate in?
Just one sec. And there is a big difference versus every DAO that I know, at least, that we have one token holder, one vote.
Right.
Rather than one token, one vote. Because I'm looking at the US and what's happening there right now. Imagine that people's vote was based on the balance in their bank account.
Yeah.
Do you think that people would actually vote? Or you would just look around and kind of go, well, those 5 guys can make a decision anyway, so why would I bother? Right. It's exactly the same thing. If you want to bring next billion people, you can't actually have one token, one vote, because it disenfranchises, disconnects them, and makes them less active. Right. So governance is huge. And another thing that everyone is using is learn and earn, because you know what? These people are fresh, so we have to explain staking, normal staking, liquid staking. And this is the way we introduce, for example, partnership with Metapool, because, all of a sudden we have an opportunity to help another project in the near ecosystem and get a lot of users.
That's part of my question.
So we actually introduce our users to projects on near, which is one of the reasons why we are really, really keen on chain signatures or chain abstraction, because imagine that our partnerships would not be limited to just near ecosystem, and we would be able to partner with absolutely any chain and any dApp that people would not need to go to that chain, create an account, fund it, bridge assets, but they would be able to do it inside Sweat Wallet.
Right.
That's a dream come true. It is very, very fascinating journey, but the most important thing and the most fascinating thing for our users is all of the stuff that we do creates more value in Sweat. And Sweat is a tokenized physical activity.
Yes.
And if physical activity is more valuable, that brings more users into Sweatcoin and Sweat Wallet, and all of a sudden it becomes a flywheel, because I don't think I showed this to you. We've actually calculated unit token economics for our users. And when I showed it to a couple of capital allocators, they're like, you did what? What? Well, we calculated token economics per user, and every user that we have right now, net is positive. So tokens that we emit for steps and everything else are fewer than tokens that these people put into grow jars, into fees, or revenue that we generate on these users. So
what would be your incentive to move more users towards the crypto side of the house? We've talked about their incentives.
Yeah.
Let's talk about yours. What are the incentives to move the 100 million over? Is it higher revenue per client? Is it a reduction of cost of infrastructure?
Our North Star metric is the value of the active day. Because guess what? All of our incentives are aligned through ownership of sweat.
Yes.
If we make your active day more valuable, you walking, us as a team, and our treasury are feeling heck of a lot better. Right. So our mission is to make the world more physically active. Our metric is to drive the value of 10,000 steps up, which means that I can stand on stage and I can say that we are moving the value of movement forward, as opposed to standing there. I just want to have a price of a token,
right?
Which is greedy, and it would be like CEO of a company kind of going, you know what? I just want a price of stock going up. And we know that some of them are doing some dodgy shit to achieve that. But if our token goes up, everyone benefits. People are more active. The externalities are incredible. I mean, we've done, you probably didn't manage to vote that. We've done this, well, we call it academic research, but one of the biggest issues that we've encountered when we, starting from 2021, we're like, sweat token is the value of physical activity. And people are like, but what is it? We're like, exactly. That's the reason why we created it, so that we can come up with the answer. 20 years ago, conversation about the value of attention was ludicrous. You knew that you had to buy TV ads. You knew that you had to buy posters, but you didn't know right now, it's like an 18th decimal. You know exactly. And guess what? Over the last 20 years, the value of your attention has skyrocketed.
That's right.
Right? So we've done this research, and we have 3 universities writing academic papers answering the question, what is the value of an active day in cash?
Cash, right.
And you know what? They're coming back with some really interesting numbers, but we're going to be probably talking about it later in the year. Probably token 2049 would be the right time, but
I'll be there in Singapore with you.
We've also asked 150,000 of our users for their estimate, right. And you know what? They estimated at $6.26 is the median number across 150,000 estimates.
That's pretty cool.
Current value is 1 cent. Yeah. It's a big gap, but all of a sudden there is not a conversation. Well, I know that movement is valuable. Everyone agrees, but how much? Right. And changing the discourse and making people not discuss is it valuable, is it not, which is the past, but how much is incredibly fascinating. And just to finish the story on crypto natives, there is one big niche that, I've already outlined, which is just one single fucking wallet across all chains that, I have one key, near key, I have one wallet, and I have one token, because we are building Sweat to be a universal gas token, no matter what chain you're on. Right. Now, if you're giving better security, if you're giving better UX, and you simplify people's lives, that they don't have to buy 15 gas tokens, but they have to buy one, we know that over time, we will have crypto natives coming over. Right. And while you can walk enough to pay your fees on Near and probably on Solana, if you were to start using Sweat Wallet on Ethereum, right, you would need to buy Sweat. That creates additional buy pressure, that creates value for Sweat, that makes physical activity more valuable. And all of a sudden you have more people joining in because they're realizing the value of physical activity into their pocket.
Yeah, that's amazing. Awesome.
we're sitting here discussing how extremely fascinating this entire conversation is. So
Yeah, but that became a monologue, unfortunately.
Nah,
That was really interesting.
Lately.
It's really interesting.
Yeah?
Yeah, I think I was always curious about both sides of the equation of what is your valuable to it and what is the value to the community of crypto. So
I think Diogo asked some really challenging and pointed questions, honestly, also. So
I'm the interviewer, right?
Yeah.
Yeah, come on. You know, kind of.
Gonna say that.
So, as a capital allocator, why Hunt Ventures still didn't take a 10 million position in Sweat?
And Swag, that's an interesting one, like pitch on the fly. We actually haven't done that much consumer, to your point, so I do think it's going to change quite dramatically going forward. We have done a little bit of decentralized social with massive air quotes.
Yeah.
We've started like putting some positions into things that are clear. We've done some investments historically that are known around NFTs, which, some type of behavior, there's consumer behavior. I do think that we were trying to objectively look at what was standing in the way of a lot of these applications to come. And there's a lot. There's lack of innovation. There's regulatory pressure.
Of course, yeah.
Founders in the US are not incentivized to start companies in the US, blah, 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 blah. There's all these things. And then objectively, there were actually like some clear barriers of entry around, we're going to build on this chain, but tomorrow that chain is going to show up. I don't understand how to bridge this. And I do think that things like the near chain abstraction, things around creating keys and having all these values like be part of the keys, and I think it's actually fascinating. Just the chain abstraction building block itself is really cool. And
Or trading keys as opposed to assets.
trading keys, exactly, as NFTs, because
Yeah,
you're kind of like
yeah.
owning or even as like you're
That
trading the
just
keys.
changes
the history.
completely the paradigm of kind of
So that's
what's trading.
On the other end, as an investor, it's like, okay, cool. It's a massive building block and we just invented it now. And so what does actually that mean for all these other chains? What does it actually mean for all these aggregation layers? What does it actually mean for these bridges? What does it mean for the rest of the ecosystem? And the answer is not clear. So there's a lot of
Yeah.
trying to see the data points. And I think the job of a venture capitalist is not to see the future or try to predict it. It's really to see the present clearly. And so if that's what you're doing, then what we're doing is like we're looking at opportunities that are retail opportunities that make a lot of sense with fantastic founders, some of them Web2 founders that use crypto in the sense of like cryptographic and economic incentives to build really cool applications that just make sense on their own. So I think your example is a perfect example just because it's a company and a product that works on its own, and then there's a crypto path. And that's actually a great example of like a potential like type of investment that makes sense in this. And there's hopefully more like this because it can't be just a few companies. But
We'll give you a discount. That's okay.
there's this. Thanks for inviting me. This is fascinating, and I really like the space.
Thanks, man. No,
Of
it's kind of your take on space is fascinating. I'm gonna steal your analogy of
Please do.
languages and operating systems.
I think it makes sense.
Very cool.
Yeah, thanks for having me.
Anytime.
Of course. Thank you.